Good day, fellow investors. Today I want to talk about something that could trigger the next black swan event. Of course, if we talk about it, it's a gray swan, but nobody's talking about it. Therefore, it's extremely important because everything is brewing to a black swan. And before we start, just a notification here. When it comes to investing, especially your investing, it's your money and it impacts you personally. However, for everyone else, it's just a business regarding your money. That's something very important to put into perception now for the things that we are going to discuss. It's your money in the hands of other people. Keep that in mind. And speaking about my money in hands of other people, this week I received an email from my pension fund, which is one of the three very important pieces of information that led to this video and the next black swan. My pension fund decided not to invest anymore in fossil fuels, and then I digged deeper. A lot to talk about general pension funding investing that impacts all of us. One pillar of the next black swan. Of course, market valuations. Is the market overvalued, undervalued? Where will the market go? That's irrelevant. Something else drives the market. And that something else is our purchasing power, our wage, which then depends also on inflation, and that's exactly the black swan. The future loss of our purchasing power. Even those that expect inflation, they expect that wages and everything will be growing at the same rate, so you don't actually lose purchasing power. But what if our purchasing power is below the rate of inflation? Then we get poorer and poorer, and that's something that seldom I hear about. The Fed or things like that, they don't even mention it. So it's something not considered by 99% of the investment and economic geniuses out there. Therefore, we can consider it a pretty much black swan. In this video, we'll discuss the details, what can lead to the trigger, to the situations in the future. So please, to support the channel, smash that like button if you enjoy the content. And I'll try, of course, to give you the key takeaways to think about when it comes to your life to best prepare yourself for what might come in the future. So let's immediately start with my pension funds. It will be closely correlated to your pension funds because pension funds are pension funds. I have a Dutch pension fund, one that I have built over 3.5 years, that I was working in the higher education system of the Netherlands as an assistant professor of accounting and finance at the Amsterdam School of International Business. Got this email and they said that they will not invest anymore in fossil energy, which made 3% of the portfolio. Then the geniuses said that they are going to sell it in the first quarter of 2023. So you have 15 billion of assets and you want to sell it, and the first thing you do, you shout it to the world, hey, I'm selling, I'm selling. So you're practically dumping something on the market. That's pure value destruction. That's what our pension funds do with our money, and that's something to be put in jail at least. To shout that you will sell something and then sell it. Geniuses. And then they're going to invest in renewable projects, and yields on renewable projects are ridiculous now. Plus, this is a copper mining operation. Copper is a commodity. 4 tons of copper go into these renewable projects. So yes, of course, fossil fuels, we are sustainable, blah, blah, blah. And to dig deeper, why are they selling fossil fuels? Because it didn't have any impact on the returns over the last, I don't know, 20 years or 10 years that they are measured. It didn't have any impact because their investment thesis is flawed from its core. Pension funds invest according to market capitalization, efficient market theory, and diversification. So this is the market capitalization of Gazprom, for example, and here, 2007-8, pension funds, especially British investors, invested in Gazprom like crazy. Then they sold like crazy in 2008 and discussed how it's terrible to invest in Russia. Of course, some people bought here and the rest is history. But Keep in mind, market capitalization is the key driver of their investments. And then I dig deeper into their portfolio, and then we have real estate 10%, stocks 36%, fixed income 34%. Of course, the most invested in financial institutions and governments, which means there is a huge exposure to interest rates. Of course, the portfolio is mostly focused on North America because that is the biggest market in the world, and they just invest where the most money goes because the market is, of course, efficient. But it's my pension, it's my money, and then I'm thinking, what are you doing with my money? I don't care about the efficient market theory. I care about my yield, my real purchasing power in the future. And here there is a huge disconnection. I just analyzed this company, Dow Herberts, and they have issued bonds 7.6 years average maturity at a coupon of 0.47%. So that's practically free money. Who bought these bonds? Of course, pension funds. By the way, as I'm researching this, I would love to hear from Americans their comments on Ph.D. So they want to expand into America. How is this going? Can this really compete with the Starbuckses, Nespressos, Nescafes and everything? Please let me know if you have tested it. What's the sentiment just for my research? Please let me know that in the comments. Back to fixed income, let's look just a little bit at yields. This is the yields on US Treasuries. So what is this? Average yield maybe 1%, 1.5% on US dollars. Then we have high yield, that's 4%, but everything else is there, 1 to 2%. High yield is junk. Keep that in mind. If we look at the high yield in Europe, it is 2.7%, and it's much higher than it was closer to 2% just a while ago. Of course, pension funds are not allowed to invest in junk bonds. So my conclusion is that 50% of the portfolio, be it likely the real estate, the stocks, and the fixed income, is invested with an average yield likely of 1%. Because if they would go to higher than 1%, they would go to maturities of 10-15 years, but still 1.5% in Europe is all 1%, so let's say average 1%. Imagine a world where inflation is 4% over the next 10 years. This means that if I make 1 and inflation is 4, I have a negative return of 3% per year in real purchasing power. Anyway, with 1%, the 250 billion they have in fixed income will be 275 billion in 10 years. However, with inflation, things that cost now 100 will cost 148 in 10 years. This means that just for a zero real return, the 250 billion should be turned into 370 billion, not 276 billion. And the 370 billion would mean zero real returns, zero increase in my actual wealth, zero increase in my real pension power. But they are going to destroy my real purchasing power, and when that hits us, that will really shake what is the current financial environment. Because you expect to enjoy your retirement, okay, I'll have so much, I'll be able to do this, do that, and then retirement comes, and then you see, okay, I can't do that. And that's already a big hit on spending, on everything, on the business models that are currently created on the current financial system. And why do pension funds do that? Because they really don't care. They have a system, they are paid to follow that system, and that system worked greatly over the last 40 years. But this doesn't mean that it will do greatly again over the next 4 decades. Everything did really well over the last 40 years because interest rates just went down, down, and down. When interest rates go down, the value of financial assets goes up. This is, again, interest rates, 1981, just straight down to the bottom. Look at the ratio of financial assets in the US compared to GDP. It was below 2.5, we are now at 5.6. ratio of US financial assets to GDP. So if those interest rates revert, if there is inflation higher than the yields, there will be a lot of value destruction, thus purchasing power destruction. This is the real game changer in the next 10 years. Of course, some people say indexation will save us because pensions will just be indexed and then again you have nothing to worry. But for indexation you need the government. And if we look at the finances of the government, every government is borrowing hand over fist. 21% borrowing in 2022 for the federal budget. Europe, huge national debts in relation to GDP, especially in southern countries. France is also a southern country. And then we have the less indebted, but still indebted north that will have to deal with this at some point in time. And then, as Warren Buffett says, only when the tide reverts, this is the tide that has been going up and lifting every financial asset over the last 40 years. Only when the tide reverts, we'll see who is swimming naked. In this environment, pension funds and my pension and your pension is naked. And that means that it's most likely that in the coming years, the impact, the risk of the pension will be one of the pillars that will lead to a big loss, permanent loss of purchasing power. That will then also impact consumption, which is the key driver of our GDP, and create a downward spiral. If there is that spiral starting, it will affect the markets because the markets are currently in an environment that expects great things to continue forever, that expects great financial terms to continue forever, and every business model is based on that, and consequently also market valuations. If we look at the S&P 500, the current price-earnings ratio is 30, and if you look at history, it has been that high only in the exuberant 1990s, and this was because earnings fell. So this was when the market was that expensive and returns have been terrible for the subsequent 10-15 years before the Fed intervened to save the market. And all this exuberance and also the high valuation is based on future earnings growth. The current earnings of the S&P 500 will likely be here $200 or 200 points, and then are expected to keep growing at 10% likely into eternity. And this is what is priced in the market. But if the purchasing power declines, then of course these earnings won't be there. And now you'll say, okay, inflation will be indexed, everything will grow even if there is inflation. That is even better. But there is another game changer that few think about, and this is it. The next billion people will come into the middle class over the next 10 years from Asia, and 2/3 of the global middle class population will come from Asia. And you have an army of 5.5 billion people versus what is a billion in Europe, 340 million in US, Canada, 400 with all North America. And we are 1-point-something billion versus 5.5 billion. They will start having their demands, and we will compete for the same commodities, the same base materials that create our lives. And there is where another issue will start growing, as we have been seeing it over the last especially 12 months. It's not just China producing for us, it's already China consuming what we usually consume. News last week, also you had it on Bloomberg, China overtakes the US as the global wealthiest. This is reality, people. And the problem is that the financial assets explosion is just thanks to that. This leads to the next problem. We feel extremely rich because of the financial assets we have. But if we look at the total composition of US wealth, It's homes, where home prices exploded over the last 20 years, pension funds that we already discussed, and other financial assets, markets, etc. So if this starts reverting, if the tide, and the tide actually makes here 86% of the assets, then also that will impact purchasing power. So we had the great financial crisis, we had the COVID crisis, and household net worth more than doubled over the last 15 years. The problem is that everything is based on debt. We see here government debt exploding over the last 50 years, corporate debt going higher and higher, and having debt means just spending our future money now and having to create value somehow or destroy value through inflation to pay back that debt. And no matter what kind of debt, debt is always debt, it trickles everywhere. So if the Fed, the lender of last resort, gets too indebted, then we have a problem, Houston. And this led to a spiral of money printing, high valuations, low inflation, and will revert one day because it's unsustainable, and that will be an ugly day for all. And will lead to, again, our gray swan, not to call it black swan, that will be triggered by the loss of purchasing power. And now we have something even more important to bring it to a personal level, to bring it to an investing level. We mostly feel rich, we feel geniuses if we have been investing in the market. But look at this, this is the number of hours US average wage pay needed to buy one share of S&P 500. Now it's 129, but in the 70s, 80s, early 80s, it was even 15 hours. Now you need 130 hours. So almost 10 times the hours to buy the same thing, the S&P 500, which is a part of the US economy. Now you have to pay almost 10 times more. So are we really wealthier? If you had wealth in the past, okay, you are wealthier financially. But if you want to build wealth, then you are again in a pickle. You can pause this video a little bit and just enjoy the power of this chart. It doesn't need any comments. Then if we dig deeper into wages, if we look at the growth for wages, it was an average 3% over the last 40 years. And then you say, okay, 3%, that's good. If we look at inflation, the inflation rate was 2.5, 3%. So you can say that was in line with inflation. But if you measure inflation, how it was measured at the beginning of the 80s, before they constantly started lowering interest rate, then real inflation is closer to 7% on average, which means that your purchasing power actually declined by 4%. You can read more on shadow stats. So this is really important to know, and this also leads to wealth gaps, of course. If we look at income, the upper income is now making 48% of income versus 29 50 years ago. So if you have money, you make more money. And this might lead to another black swan. When the majority loses its purchasing power, we might see pension funds, people employed by government, everyone angry because they can't buy the things they expected. This Occupy Wall Street was the repercussion of 2009 financial crisis, but if we have a purchasing power at scale hit, then this will be much bigger. Now, I have no idea how politicians will react. Actually, I have an idea, but I hope it won't be like that. They will. Higher taxes, higher inflation for some, more debt issues, but even less purchasing power, etc. So it might lead to a spiral. I hope they'll find a way to deal with that, and that will not go into the ugly part of long-term debt cycle, refinancing, etc. But it's something we'll have to deal with someday. Okay, so we have the fundamentals of what is in our financial environment, what to do. Of course, you never know when will this happen. We might have another 5, 10 great years, and then in the 11th years, doom and gloom, and whatever I said here might look stupid for the next 10 years. But you can think about the risk and reward when it comes to investing, and avoiding the stupid things, it does great for the long term. Even if the return is the same, but if you avoid that stupid things, then your risk is much better and you are much more certain that you will get to your financial goals. First is, of course, build another pension pillar, takes at least 10 years, requires work. And now you say, Sven, we are hating you. I hate you, Sven. The Fed is just printing money and you tell me I have to work more. That's reality. You see whether you want to follow the Fed and Jerome or you stick to this channel. That is still an option if you can structure a good deal. Free money is free money. If you can structure a good deal that covers the debt, that there is no risk, then that's still always an option out there. Buying businesses, if they have pricing power, so if they can deal with that inflation globally, even if it hits us in the developed Western world, that they can diversify and still deliver value, and then from that business, then that's something very interesting, of course. And the key message is just think of your personal situation. It's your money, it's personal, it's none of other people's business. It's your personal situation, and think how it fits long-term, the current environment, the long-term risks. Timing is also, okay, you say 2 years will still be good, okay, but know that at some point the risks will likely materialize. What am I doing? I have a global portfolio. I like to be exposed to that 5.5 billion people, middle class, emerging, buying power. So that I hope will increase my purchasing power in the long term, especially because it's cheaper now. Of course, I have a global digital business, so that also helps, but I have worked on this YouTube channel for the last 5, 6, 7 years, 10 years. So that's also something to think about. I will look for a 1% loan if I can get it in 2022. So the focus might also lead a little bit there. I have no personal debt. I'm working as much as I can. I'll be editing this video today till midnight likely so that it can get out in time. And of course, the key true reason to wealth is spend less than what you make and have that money create real value for you. Of course, always be patient. People always ask me, Sven, what to do, and they want to solve their financial issues in 1 second. No, it takes a decade to build something of value and a good portfolio. So thanks for watching. Check my research platform while it's still low priced, so lock that price in, and I'll see you in the next videos where we'll discuss investments that might increase your wealth no matter what happens. Smash that like button if you haven't.